look at the UK, even more so than the US, the UK economic environment does not warrant the current policy rate by the Bank of England. Now, the Bank of England, similar, is waiting. They're going to wait for the Federal Reserve to raise rates. But if any of you have been to London in any time over the last 2 years, you cannot walk 5 blocks without running into a building site. It is unbelievable. It's not just London, it's Liverpool, it's Norwich, it's all the places in the UK. But clearly the level of rates is not appropriate for the economic activity that we've seen in the UK. And then lastly, we're going to talk about Europe. The QE program there has become really pretty pervasive in terms of its impact in the market. And one of the things I would say is interesting is that if we look at the recent volatility in, let's say, commodities or stocks, one of the things that hasn't moved at all is actually the German 10-year note. So granted, it's only at 60 basis points, but it really hasn't moved at all. Neither really has a 10-year gilt, and neither has a 10-year treasury. Because in my mind, these assets are really underpinned and totally underwritten by the quantitative easing program, by the ECB and by the other central banks. And so as an investor, it really makes us want to move away from those products, A, because they're low yielding, but B, they don't have any volatility, so the chance of making money with them makes very, very difficult. But the one area that we do continue to like is peripheral bonds like Portugal, for example, where you still get 3.5% yield for a 30-year bond, which is, in this world, is pretty attractive, and the underlying fundamentals are pretty strong. But the Eurozone, the data is improving. The economy is responding to a lower euro and lower oil prices. And it is a situation where I think the QE program will end in 2016, but I also think that it's pretty pervasive until we get there.